Morning. Assalamu alaikum wa rahmatullah. First of all, I'd like to say it's a pleasure to be back in KL, a jurisdiction which is a clear global leader in Islamic finance. And I'd like to congratulate BNP and NCF on its third-year anniversary of the Center for Islamic Wealth Management, and specifically thank Professor Shamsher for his kind invite and to your team for putting together a fantastic event. I think wealth management is a key arena which is sometimes overlooked by the focus on Islamic banking, particularly as we see in the asset management sector. If we look at the equity side, it is somewhat bitty, and the size of the equity funds, Islamic equity funds, tend to be quite small. I think this highlights the need for further development of the sector, and I'm sure that the excellent strength and depth of expertise which NCF possesses, coming together with BNP, its international footprint, is a powerful combination. I know Dawood Abdullah's regularly in the UK and other parts of the world promoting NCF, and I think this combination makes a lot of sense, so congratulations once again. I think just in context of a point, if I may, which Nick, you mentioned, of the financial crisis, I think when you take this conversation today and you frame it in that context, it is extremely, extremely pertinent that we look at socially responsible investing and we look at Islamic finance as a subsector of the broader ethical finance arena. For myself, for us at the Council, being based in the UK and living in Europe, I can say that many people from across society, regardless of race, religion, or ethnic background, are key to see a more socially responsible and systemically stable form of banking and finance and asset management. And therefore, I think I very much commend the launching of this book. Indeed, in the first sentence, you refer to the Methodist Church, which highlights the shared values across the Abrahamic faiths in managing wealth. And indeed, to some degree, highlights, the question, or raises the question, how we perceive wealth and what is the purpose of wealth. And in this regard, I would very much encourage the center to further focus on this SRI theme, but very much through international collaborations, and to take this message out at an international stage. I think SRI, ESG, carbon divestiture, impact investing, transfer of wealth, stranded assets, issue of millennials, all of these things are key trends that we're seeing in London, Europe, and the US. And accordingly, I would very much encourage the Centre to bring further the Islamic wealth management agenda within this context, within this frame in Europe and other international jurisdictions. Very much, indeed, I think we can say that Islamic wealth management can have a significant role to play in two areas. One, bridging with a conventional ethical finance universe, which is, guess what, considerably larger. So even as a commercial play, that's where you're going to find a lot more opportunity. But also, I think the wealth management arena can, to some extent, address the aspirational dissatisfaction amongst consumers, which is creeping into Islamic banking, sometimes due to the overly synthetic nature of certain Islamic banking products. Time permitting, I'll try and touch back on this theme later on during my presentation. But for now, I'd like to very much focus on Islamic private equity. By background, I'm a chartered accountant. I sit on the board of the Islamic Finance Council UK. I used to be head of Islamic finance for Ernst & Young in London, spent over a decade with them. But I work over the last 5 years as a consultant to a private equity investment manager based in the UAE, in Dubai, RHT Partners. The council, it's a not-for-profit body that's established to help promote the Islamic finance industry. It's led very much by practitioners in the industry, and we focus on 4 key areas. One is government policy advisory. The second is Sharia development, to help improve the framework for Sharia governance. The third is executive training. And the fourth, most interestingly, is ethical finance, where we've been the leading platform bringing together all the different players in ethical finance, from the credit unions to the asset managers to the banks to the monetary reformists, indeed to the church and the other faith groups as well, bringing together all these different players to see what are the synergies, what can we learn from one another, what can we share, where can we collaborate. At RHD Partners, we focus very much as investment manager advisors in the private equity space, looking primarily at growth capital situations, and also acting as advisors to our partners. That includes working with an exclusive group of high net worth individuals, family offices, royal groups, based not only in the Gulf but also in Asia and Europe, very much across the Silk Route, looking at co-investment themes. So before one talks about private equity, I think there's need to demystify what is private equity. Other terms you will use, if I can try and simplify this and make this as broad as possible, other terms you will find which are used to describe private equity include direct investments, principal investments, you might have heard the old term, leveraged buyout funds, and so on. Effectively, this is investing in companies which are not listed or publicly listed on any exchange, right? So that's why it's called private equity as opposed to public equities. I think we'll hear from Monim later on the public equities space. And if you think about that in the principles of Islamic finance and risk sharing and musharak and mudaraba investments, all of a sudden you'll see, there's actually quite a close alignment in the philosophy and the mindsets of taking direct stakes in equity stakes in businesses. The spectrum typically varies from early stage venture capital across to the growth capital space, right across to the more mature, larger deals, which are typically referred to as leveraged buyouts. Venture capital, again, is characterized, I would say, by a friend of mine once described it very much as a kind of splattergun approach, where you'll throw your money at maybe 100 deals and maybe one or two of them will stick. And the ones which stick tend to be the next Uber, Facebook, Apple, whatever that is. So you tend to make a lot of money in that space, which offsets the losses in the other ones. One of the most formidable VC investors in just after the dot-com crisis in the early 2000s, a chap called Morten Lund. He was one of the early investors in something you might have heard of called Skype. And we had a lovely conversation once, and he said to me, Omar, the theory in investing in venture capital is one of two things. It was either you know the business model and the business sector inside out, and you back that because you know that, or you just trust the team, the people who are running this company. So very exciting space is venture capital, high risk, again, high returns. Growth capital space, where we typically operate, is more looking at businesses which are already revenue generating, already profitable. They might be 10, 15 years old, could be an owner-managed business situation, and that business is in need of capital to grow, to restructure, to expand its activities. That will typically involve us getting involved in the business, injecting capital, taking a significant stake, either a majority stake or a complete control, 100% stake with, of course, a small portion for management, and turning that business around. So getting involved, recruiting a new CEO, bringing in new management, using our networks, our relationships to help develop and build that business out. And I'll come back more to talk more about that process. And leveraged buyouts typically are large firms, well-established firms that have a higher kind of enterprise value, and you will literally go in, take on considerable debt, and buy that firm out. The structures used in the private equity space, you'll hear the term GP, LP structures. Effectively, this is, I would say, more predominant in Europe and the US, where the limited partner represents the pension funds, the insurance companies, the family offices, and the general partner would represent us, who would be the kind of manager who would go out, the asset managers, fund managers, private equity kind of investment managers, who would go out operationally and find the companies and so on. So what do? You look for a target company, you acquire that company, and just to be clear, when we say we look for a company, we could get maybe 200-300 things coming through our door in a year. From that, we will narrow that down straight away to the top 10, 15. From that 10 to 15, there might be 7 or so. This is just our experience that we would actually go and do due diligence on. That would incur considerable cost, legal due diligence, financial due diligence, and so on. So we could end up spending $100,000-$300,000 just doing our diligence on a company. Then you will find many a time actually we haven't invested in the company, or for some reason the deal falls apart because of something sometimes rather funny or out of the blue, something random. And then you end up whittling down to kind of 2 or 3 deals that you actually will close, you actually will invest in. So it's quite a lengthy process, and as you can imagine, it's really a process of sifting through a lot of potential targets to find the real gems, to find the businesses which are really undervalued, the businesses that you believe you can add value to as well. And that goes to the second point, is where we would improve that business, look to address some of the issues, the challenges. Sometimes it's a case of just needs professionalization. Sometimes it's a case it needs to internationalize, to outsource, to insource. And we would take 3 to 5 years typically is the process that we would get involved with the company to improve that business. We did a study when I was back at EY, and the study indicated in US and European, US slightly more, and European private equity buyouts, typically the CEO would be replaced in 60 to 70% of the cases, and there'd be new management coming in. So normally we do that, bring in a new team. They get incentivized quite aggressively, so they know that we are a private equity owner. They know we have a roughly 5-year horizon. So they'll take stock in the company and they'll be incentivized. And you'll be surprised what you can achieve when someone's incentivized considerably. And that's why we always talk about incentivizing them to do the right thing, which is to improve the business, not to accept second best as an option, but to really drive that bottom line profits. And that's where we as equity investors are aligned with. And then typically the businesses are sold. They can be sold either through a secondary, that's referred to another private equity firm will come in and buy the business. It could be sold as a trade sale, whereas you would sell it, in this case, to a company which is sitting within your sector, within that sector. So if you're manufacturing tires, another tire manufacturer will come in and acquire the business, or a car manufacturer might come in and acquire the business. Or there will be a listing or an IPO of the business. That's in summary very much what's involved, and I'm conscious it's not the detail of which is something is not necessarily as prevalent or as understood by many people as one may think. So where are the kind of risks, and where is the kind of concept of risk here across this business cycle that we have in private equity? First of all, I alluded to earlier, we're taking equity risk. Many times I've heard Islamic banking and finance is a form or prefers equity-based financing as opposed to debt-based financing. There's a fundamental difference between the two, and that has considerable macroeconomic implications. As a banker, when you finance something on debt, you don't care about the bottom line profitability of the business. You care about your covenants, your security, and to ensure your debt can be financed. When you invest in equity, if the business loses, you lose. And if the business goes well, you do well. And that's why we see a larger alignment, and this is one of the reasons the macro economists talk about the distribution of wealth being more aligned. We're not transferring away this risk, as you'll see in the banking sector, but rather it's something that we are embracing and we are managing. And that's why the insights and the flavor of risk as understood by a corporate financier or a private equity investment manager is very, very different to the flavor of risk as understood by a chap who works in a banking department responsible to issue junior term or senior term loans. core areas of risk typically in private equity, as you'll probably gather, is the due diligence. What is the company that you're buying? Doing the financial due diligence. Is everything there as it is? Is everything stated on those accounts true and correct? Are there any funny provisions, any hidden provisions, any questionable valuations that are hiding away somewhere in the accounts? I was watching a documentary the other day on the Olympus, the camera manufacturer, the situation with that in Japan. And if we look at Tesco in the UK, many of these companies will be, stating revenues using sometimes dubious accounting policies, or will have provisions masked and hidden in different areas. So the financial due diligence is key. The commercial due diligence is key. Where is this sector heading? Is this sector about to be changed and turned upside down due to technology as a disruptive force, like we're seeing the Uberization, as we could say, of many sectors, as Uber has done to taxis. So that's some of the core areas there in the deal sourcing. You're also very much typically looking for proprietary situations. You don't want a deal that's marketed, that's open, that's out there, that an investment bank has been engaged to sell this to. Normally, once things are out on the open market, the prices begin to vary and move around. You want something which is off market and proprietary to you. One of the keys we say internally to successful private equity investing, you remember on the previous slide, I just referred to the exit, yeah? So the cash is made on the exit, right? Yeah? As you would expect if you follow the cash. However, the funny thing about private equity is you actually, from our experience, what we've seen, you actually make your money on the way in, not on the way out. So the trick is very much about buying well. If you buy the company well, if you can negotiate and close in at a good price, you will do well on the way out. Yeah? Most people tend to think, oh, you make your money once it sells and you get a great IPO. Yeah, that's you actually realizing the efforts you put in at the beginning to actually acquire the company at a favorable price. And additional cream is made once you build that company out. But the more seasoned professional will tell you you make your money on the way in. Layering on top of this some of the Islamic additional risks that we see in Islamic private equity. So Islamic private equity versus conventional, what are some of the key differences and issues that we have? First of all, sectoral, like you have in the public, in Islamic equity screens, listed equities, there's the natural sectoral restrictions. You cannot invest in anything deemed as a sin sector. As my English or Scottish friends, I should say, in the UK would say to me, you can't invest, Omar, in anything that's fun. Right? I was like, okay, it might be fun to you. But for others, it's a sin sector. And there's a lot of crossover between that and the SRI universe. Leverage, I place that as a question mark, and I'll come back to that. There's a restriction on preference shares and mezzanine financing options. Typically, when you come in, you buy the ordinary equity, but you also have pref shares put in as well, which puts you in a slightly stronger position from cash flows. But from a Sharia-compliant position, there is challenges on that. But I would say the biggest singular issue, and this might shock a lot of you, it did shock me initially, and it continues to somewhat confuse me, is IOFI, IFSB, all the Islamic equities index, I'm sure you're all familiar with, they have very clear parameters of sectors you can't invest in, and they also have parameters of financial ratios, right? Okay? That exists, it's established, it's all there. Guess what IOFI and everyone says about private equity? Yeah, exactly, nothing, right? There are no guidelines, formal guidelines issued by IOFI or any of the other parties talking specifically around the do's and don'ts of Islamic private equity. The rules that have been created on the public listed equities are on the assumption, on the basis that you come in, you've got a 0.5% stake in this business if it's a large, or even less than that, or 1-2%. But on the private equity side, surprisingly, there's nothing there. And I've raised this with Sharia scholars a number of times, and I'm still waiting for an outcome. Unless something has happened in the recent past that I don't know of, there is still a big gap there. And that's quite worrying, because that brings in what? It brings in practice, varied practices, varied experiences. So when I speak to my friends in Bahrain and other parts of the world as to what they're doing, what they are, if I can use the word, getting away with, or with the Sharia scholars, or how they are managing their things, their investments, you have this market practice which is very, very varied. Typically, what does that involve? So, okay, now if you're buying a business, the sectoral side is fine. We can't invest in these sectors, that's okay. But now you're buying a hearing aid manufacturer in London or in Europe. Now, typically that company will have conventional debt on its balance sheet. So what do? Do you refinance? Do you have to refinance? Again, there's no guidelines. If you refinance, how do you refinance it in Europe, where there's no availability, or in China, where there's no availability, or in India, where there's no availability of Islamic financing, right? What do? Do you go down ijara structures, commodity muraba structures? What do you? Okay, if you go down those structures, can you go down those structures from a local, legal, regulatory perspective? Okay, if you can or you can't, then is there a tax implication of doing such? So all of these issues now start to come into play. Sometimes we'll find scholars are coming in, and this is all part of what I would say the Sharia risk is, and they say, okay, gents, we'll give you you can buy this company, it's all fine, that's fine, but we'll give you 3 years to refinance, to convert the debt into Sharia compliant debt. And then you negotiate with the scholars, yeah, Shaykh, we couldn't find anything, and that's fine. Sometimes, because you've got to remember, what did I say was the time horizon for us? What did I say? 3 to 5 years, exactly, right? So if you've got a grace period of 3 years, and with a bit of baklava, you take that forward, right? You can, with respect to the scholars, it's a morning session, I'm just trying to keep everyone awake. You can work on that sometimes, and then you have a grace period. And then what happens? Purification. Do you have to purify because there was non-compliant debt there? Do you? Do you not? Actually, very mixed, very, very mixed answers and practices going on out there. In some cases, no, you don't. And then the other area I think is going more holistically beyond the balance sheet, and this is something we try to look at RHT Partners, which is when we say sectoral is a group of negative screening that we've taken, but there's also the opportunity very much to be progressively, to be positively screening. So to invest in sectors in education, sectors in areas that can help promote the development of society. So for example, if we're getting returns of 15% in the next KFC investment in Abu Dhabi, or 15% exact same returns in the next special needs school in Abu Dhabi, which one would you like to invest in, right? You'll find certain investors, assuming risk parameters are the same and returns are the same, might prefer to invest in things which are deemed to be more socially beneficial than another fried chicken shop. Looking at Islamic principles of management is something we did some analysis with, together with CAS Business School some time ago in Hermes, which was to look at the business not just through the balance sheet, but actually looking at the business, the culture in the business. How does the business deal with its employees? How does it deal with its suppliers? How does it deal with its customers? Is it polluting the environment? All of these things to create a kind of more cultural understanding. Again, this is not required. There are no guidelines. Even in listed equities, Mona will talk about, there's no requirement that you have to go look at level of pollution and X, Y, Z, and there's the certain amount of carbon neutrality that you're allowed and so on. But it is a general principle, is something that we've been particularly interested in to look at. So, summarizing risks, same risks as conventional, the commercial risks, the financial risks, the deal sourcing risks. Additionally, in Islamic finance is the availability of Islamic financing options for senior secured lending or debt, for working capital facilities. Managing the Sharia expectations, as I talked about, there is different differences of practice there, and what do you do if you have to unwind a position because a Sharia scholar says, no, well actually we're no longer happy with this. And of course in the financial side there's a lack of kind of hedging instruments as well sometimes. Just in general, and in closing, a couple of points around managing risk. I see the term risk, managing risk, risks in is something that Malaysia has been looking at over the last kind of 4 or 5 years, and I welcome that. Managing risk for public good. I actually think the last time I was in KL, I was in this hall sharing a platform with Professor Abbas and Mirkor and others talking about managing risk for public good. I think it's just something we should reflect on, and going back to the point, Nick, which you made earlier about the current financial kind of climate where we're sitting in an environment in Europe and the West, for sure very overtly, maybe less so here, but the current system has proven to have serious systemic issues, has failed a lot of people. We have bailed out banks to the tunes of trillions of dollars, to the extent that we could have had free healthcare, wiped out global debt, and so on. So there's a question about the system, but also a question about the way people in the system have been running. So not only is there systemic issues, we're finding LIBOR fixing scandals, mis-selling scandals, these things just money laundering scandals and so on from Mexican drug lords and so on. So these things continue to kind of perpetuate, and we have to question about the kind of moral bankruptcy of the system. And I think now is a great time where people are actually open to alternatives. People are willing to listen, and indeed they're looking for a degree of leadership. And I think that's where Islamic finance, whilst it may not have all the answers, I think the experience that we have had here in Malaysia and Bahrain and the other more developed countries, and indeed in the UK, is something that can contribute to the debate, can help to lead the way or present an alternative paradigm. I would say within the industry specifically, just concluding on the point of at a more holistic level, is when we talk about wealth management, we have to talk that we were talking about the purpose of investing. Why do you want to invest in the first place? What are you trying to gain? Are you trying to put money aside for your children's education? Are you putting money aside for your retirement? Are you putting money aside for waqf as a sadqa jariyah? Are you putting money aside for what? What exactly is it? So I think we have to look in Islamic wealth management at one thing, and I would encourage this because it links very well also to some of the thinking from the church as well, from the Church of Scotland and other faith traditions, is within wealth management at the end of the day, and particularly in Islamic wealth management, we have to ask ourselves, what is the purpose of wealth? What is the purpose of an economy? And Islamically, there is a paradigm we must never forget, which is that everything we have, there'll be an accountability, a hisab for this on the day of reckoning. And there are concepts such as barakah and halal and tayyib. I like to use the reference of tayyib as Islamic finance kind of option to do something which is deeper shade of green, like we have SRI in conventional, we have SRI, which is kind of characterized by shades of green. Similarly in Quran we are inspired by, there are different levels. There is halal, but there is also tayyib, something which is wholesome. So I think within the Islamic finance industry, the opportunity that I encourage NCF to look at is actually to create a new asset class within Islamic finance, inspired by the concept of tayyib, which is effectively integrating more SRI and ethical principles and social impact principles into our wealth management strategies, and leave that as an option for the market to decide which one they prefer to take on. And I think on finally, I always joke with my friends, but there's also one other kind of secret ingredient, maybe taking us more to a different realm. And this might be funny from a practitioner saying this, but I always say to my friends, you can't put barakah into a spreadsheet, like we can put a DCF calculation, yeah? you put a factor. You can't put barakah into a spreadsheet. So the importance of doing things and being happy with what you have, and the barakah that can come from $1 which is earned in a halal way can be much more barakah than $100,000 which is earned through a haram way. With that, I'd like to thank the organizers once again, and Professor Samsher and his team, and to Nick and Dr. Muhammad. Thank you once again. Assalamu alaikum.